Jobs Day in the U.S. Investors await today's crucial data that will help shape the path ahead for interest rates. While oil adding to gains after its biggest one-day jump in almost a year, markets rattled after President Joe Biden says the U.S. is discussing whether to support potential Israeli strikes on Iran's crude facilities. Plus, decision time, the EU votes on whether to impose tariffs as high as 45% on electric vehicles from China. Now, also coming up today, we're joined by Vlad Tenev, the chief executive of Robinhood. We'll, of course, discuss the company's first 6 months in the UK, any future plans, and actually how they see the investing landscape change. That's in about half an hour, 9:30 a.m. London time. First thing is first, let's take a look at the European markets map. And actually, a lot of these equities are fluctuating. This is because of the geopolitical tensions. A lot of expectations is now placed on the future path for Fed cuts. Now, the CAC 40 gaining some 0.6%. The FTSE over in Italy faring a little bit better. It's really the DAX and the FTSE here in the UK that are pretty much flat. Now, a couple of questions, not only when it comes to oil, which we were talking about, because of this, I guess, cryptic message from the US, if they give the blessing for Israel to actually touch some of the facilities there, 78.25. S&P futures, you can say, gaining 0.1%. The haven, that is gold, 2,661. And of course, we continue watching yen. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, it's been a pretty remarkable week for Chinese stocks after a raft of stimulus measures announced last week. Now, markets in China have been closed for the Golden Week holiday, but Chinese shares traded in Hong Kong have extended their gains. Well, joining us now is Hechler-Fayd'Herbe, Chief Investment Officer for EMEA at Lombard Odier. Thank you so much for joining us, Nanette. As always, I know there's a lot of focus, of course, on the U.S. jobs report, but I was extremely interested on some of the calls that you made as a house is not going back in Chinese equities. Do you have a fundamental underlying concern about what's happening in that economy?
I think China equities is this high beta market, Francine, which means that there is a lot of volatility and there can be very sharp gains, as we have seen more recently. So it is a market that is really very good to take tactical positions, but there are a couple of questions that we have on the structural challenges that China is currently facing. Think about the demographics and its implications. Think also about the real estate overhang. So I think we have been a bit on the sidelines, happy to participate from an emerging market equities standpoint, since it's such an important weight, but not taking yet very big tactical positions. There are still the U.S. elections ahead and trade policy decisions. So we are happy to just follow the market.
So, Nanette, when's the right time to get back into the Chinese equity market, if at all?
I think we are looking for measures that are perhaps more persistent in their outreach. For example, how we are able to see the absorption of the real estate overhang. For example, national programs to reduce unsold homes. That would be an example of really long-lasting type of catalysts to look at a longer lasting outperformance. And also in terms of reforms of monetary policy frameworks, more specific inflation targeting would be something that we would really assess quite positively. So there is a bit of a roadmap to have as well in terms of the signals that are longer lasting. Of course, the support package that we have seen has been a very big catalyst for short-term moves. But I think global investors, beyond the immediate geopolitical context that we always have to learn how to work with in an asset allocation context, is also supplemented with some of these longer lasting support measures.
Nanette, I'll ask you about U.S. jobs in just a second, but how much more volatility are you expecting from now until January, given all the geopolitics that is, again, very difficult to read, especially if oil facilities could be touched, and the U.S. election coming up November 5th?
I think we ought to prepare for some more volatility. We've seen actually the VIX already start reflecting that. And to be honest, I've been not only watching the labor market as a source of fluctuation because of the pivot of the Federal Reserve now much more onto the labor market, but I'm also sensitive to the fact that US 10-year break-even inflation has been picking up again from the 2% it had reached recently to again 2.22%. And of course, there is the short-term fluctuations that may be coming from commodities, that may be coming from energy prices, but certainly these long-term inflation expectations are also going to be determining the pace that the Federal Reserve will continue to take with respect to its future rate cuts. And therefore, I think both sides, inflation news as well as labor market news, will continue to provoke the markets to react. And of course, geopolitics, insofar as they do have an impact on energy prices, will be one of the possible sources of volatility.
Nanette, thank you. Keep it right there because the latest U.S. jobs report, as you're saying, is due out later today at 1:30 p.m. London time. Bloomberg Valerie Teitel also joins us for more on what to expect. Hi, Val.
Hey, Francine, good morning. It's a big day for the markets. We get the release of the September jobs report at 1:30 UK time later this afternoon. The estimate is for 150K jobs added to the U.S. economy. The unemployment rate is expected to stay the same as the prior month at 4.2%. Same story with average hourly earnings expected to stay the same as the prior month at 3.8%. But the range of the predictions on this number today, Francine, has been wide, going from 70K all the way to 220K. That has a lot to do with some complicated seasonal adjustments that take place this month, which make it hard to predict. But I urge you also, Francine, to look at the revisions that come out as well today. The revisions have really shocked the market in the past few months. All but one of the revisions this year has been to the downside, has been lower. So that might catch the market's eye. What also could catch the market's eye, Francine, is even the second decimal on this unemployment rate if we do get a tick up to 4.3%. Now, why is there such laser focus on the labor market? It's all because of what Powell has been saying over the last few months. I want to remind you of his specific words that he used back in Jackson Hole, saying we do not seek or welcome further cooling in labor market conditions. He went on to say in the Q&A just 2 weeks ago that the single most important data that comes to the Fed into changing their decision making will be the unemployment rate. I've got a chart coming up next which shows the trajectory of the unemployment rate. It has been on a rising path, and Citi does see a chance that the unemployment rate could rise not to 4.3%, but to 4.4%. And they specifically point to the weakening labor market sentiment when it comes to the Conference Board indicator of jobs too hard to get. That is this blue line here, which has been on a continual trajectory higher, which could lead the unemployment rate to take an unexpected leap higher today.
Thank you, Valerie. Nanette, when you look at some of the expectations that you were talking about, of course, in the Fed and the Fed cuts, is there a concern that they're actually cutting into a recessionary environment? I know we focus so much on some of the data, we focus so much on the cuts that we sometimes, forget the narrative and, what kind of economy are we left with at the end?
I think the likelihood of a recession remains relatively contained. I mean, take a look at what the ISM services have told us. Most developed markets, and the U.S. is certainly in that camp, is really depending very strongly on its services sector, much more than on the manufacturing. And services is all about jobs. It is all about giving also consumers in the U.S., which is one of the pillars of U.S. growth, a very good backdrop. So I think that recession risks at the moment remain contained. It is really this balance between, in the dual mandate of the Fed, between the inflation target that they're pursuing and then the support that they're able to give to the labor market and the real economy at the same time. For now, I would anticipate that the 0.25% reduction in November and another 0.25% remains a good base case to assume for the Federal Reserve in this balance of the two for the coming months.
Nanette, when you look at, I guess, some of the possible tariffs, given what Donald Trump has said that he would do if he becomes president, but also the fact that there could be attempts from Donald Trump to sway the Fed going forward, is the market going to react to some of these things as we approach November 5th, or do you think largely they'll just look through it until we actually know what policies will be put in place, depending on who's in the White House?
Scenario analysis is very important, and understanding how the two presidential candidates and the economic policies that are part of the campaigns are going to impact some of the determinants of inflation and of growth, which are both really critical for what the Federal Reserve can continue to do, is important. I do think that there are differences between the two possible outcomes in U.S. elections this time as far as inflation expectations are concerned, and certainly tariff policies or trade policies that are influencing prices of goods, but also migration policies that may be influencing, even if it's only temporarily, labor market conditions, is going to have an impact on the Fed. And so we would see differences here, for example, in terms of how quickly and how low interest rates by the Fed can fall in 2025, depending on who will end up in the White House and with what Congress composition that candidate is going to work with.
Nanette, thank you. Nanette Hechler-Fayd'Herbe from Lombard stays with us. Now, coming up, oil prices pretty steady after a roller coaster 24 hours. We'll give you the latest on the conflict in the Middle East next. This is Bloomberg. Welcome back, everyone. Now let's focus on oil, gaining this morning following its biggest one-day jump in almost a year yesterday. Now, this is after comments from President Biden when asked about supporting potential Israeli attacks on Iranian crude facilities.
Do you support Israel striking Iran's oil facilities, sir?
We're in discussion of that. I think that would be a little, anyway.
Now, we're joined by our EMEA News Director, Rosalind Matheson. Ros, good morning. What do you make of those comments?
Well, it's interesting because he revealed several things in very brief remarks that were slightly muffled, a bit hard to hear. One was that he confirmed that there is a discussion around hitting oil facilities in Iran. The US is obviously part of that. He also, at some point in that conversation, indicated he didn't expect the strike, by Israel that will come on Iran at some point to come soon. So he put a bit of a timeline on it. But the remark where he said anyways to me was quite interesting because he sort of indicated, was he indicating that Israel will do what Israel wants to do? What can the US in the end do aside from making, one thing very clear, which is that they would not support Israel striking Iran's nuclear facilities because the US would have to help with that. But the rest of it anyways, what in the end can the US do because Israel will, act in the way that it sees fit. So that to me was a bit of a telling comment.
So, Ros, what happens next? I mean, I know this is wildly speculative, but we're expecting a response, and then this could come from both sides, one after the other.
Well, that's right. We're just in this series of tit for tat that's been going on for many months now in terms of the direct actions that Iran and Israel are taking against each other. And obviously Israel will say, given the ballistic missile strike that it had earlier this week from Iran, it has to respond to that. It has to respond somewhat in kind. It's all this chessboard of how do you calibrate your responses to kind of be at the same level of what you just received, but also not to escalate that much further. And given that these were ballistic missiles, so less warning for Israel, they can come pretty fast. Some of them did seem to get through. Israel have to do something they consider to be at least proportionate to that. So they can't just send drones again to an Iranian, military site and call themselves done. So what will that be? Sort of further, military sites? Will it be oil sites? Obviously very important for the US too, given the oil price right now. Will it be something through proxies? We just don't know.
Okay, so we'll be here and, of course, bring you any news that we get from that. Roz and her team, as always, on top of the news. Roz, thank you so much. Roz Matheson, Bloomberg's EMEA News Director. Now, still with us, Nanette Hechler-Fayd'Herbe, Chief Investment Officer for EMEA at Lombard Odier. I guess the concern, Nanette, is that actually we're not really sure what happens next. And so there's a lot of risk. There's a lot of concern. There's a lot of question marks for investors. How do you protect a portfolio?
I think the good old premise of being well diversified is absolutely the starting point. And also taking a look at where the risk rewards are still compelling. Right now, by way of protection, precious metals and gold are one of the areas that seem like a good idea to have in the portfolio. Why? Because we do have a rate cutting cycle. The dollar accordingly is stable and not so much of a headwind. And this is one of the safe haven assets that are working really quite well when the world is becoming more uncertain. Also, a number of currencies, exposures to currencies like the Swiss franc or the Japanese yen are helping to stabilize through, especially if you are having a positive view on what is happening in Japanese equities, for example. So this is about diversification. As far as risk rewards are concerned, I always like to look at the fact that for now, corporate bond yields in the United States are offering much better yields than earnings yields on equities. So fixed income continues to have this absolute relevance in well-diversified portfolios as well.
Nanette, I mean, what does it mean for Europe? I know there's also a number of question marks over, tax-raising measures, certainly from France and other European countries. So do you stay away from Europe?
We are overall underweight Europe, not so much because we're expecting bad returns, but because in other regions there may be better ones. But to be completely outspoken, European equity markets have done pretty well if you look at them overall, and if you take a look at peripheral European equity markets, they've actually been on fire this year. So I do think that there is some catch-up potential for some of them. Certainly, as far as France is concerned, as far as some of these corporate taxes are concerned, you have to weigh the impact of the positives as far as credit spreads and the sovereign credit spread is going to be, how this is going to impact risk assets overall in France, and then also what's the direct impact of corporate tax raises on the equities and the profitability of the companies.
Nanette, as always, thank you so much for joining us. Nanette Hechler-Fayd'Herbe from Lombard Odier. Now, coming up, U.S. dock workers decide to go back to work, but as talks continue, another strike is not fully off the table. So we'll have the full story next, and this is Bloomberg. Well, U.S. dock workers have agreed to suspend their strike while they continue negotiations on a new contract. Containers ports from Houston to Miami have been closed since Tuesday, creating a backlog of cargo that could take 12 days to clear. Let's bring in Bloomberg's Bill Ferries. Bill, hi. How was this resolved so quickly, and what's actually left to be negotiated?
Yeah, so the strike really just lasted about 3 days. As you mentioned, it's not officially over. Workers are going back to work, to the job, after securing a 61% pay increase over the next 6 years in that 6-year contract. They have not resolved their concerns about automation at the ports, something that could cost many of them their jobs. That's the part that will continue, but they've set a new deadline of mid-January for that. So it gets the ports back functioning. It gets them working on that backlog of ships that they think could take about 12 days to resolve. But it does get also the American economy past this immediate crisis with the shipping industry.
And with the presidential election just a few weeks away, what political impact did the strike and its resolution have on the campaigns?
This was definitely a problem the Biden administration wanted to take care of very quickly. They're already dealing with the aftermath of Hurricane Helene. They're trying to deal with the expanding crisis in the Middle East. They did not need a major economic and labor issue potentially disrupting the campaign just 4 weeks out of the election. So this deadline for finishing the talks on automation, that is kicked back well past the election. It's something that the next president, whether that's Kamala Harris or Donald Trump, that they'll have to deal with. But it does kind of negate that as an issue for Democrats heading into the November vote.
Bill, thank you so much. Bill Ferry's there in Singapore. Now, coming up, we speak to Vlad Tenev, the chief executive of Robinhood, on markets and changes to the retail trading offering in the UK. It's going to be a good conversation, actually probably my conversation of the week. So don't miss that. That's next. And this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. It's jobs day in the U.S. Investors, of course, awaiting today's crucial data that will help shape the path ahead for interest rates. Oil adding to gains after its biggest one-day jump in almost a year. Markets rattled after President Joe Biden says the U.S. is discussing whether to support potential Israeli strikes on Iran's crude facilities. Plus, decision time. The EU votes on whether to impose tariffs as high as 45% on electric vehicles from China. So we have a packed show today. It's now roughly 6 months since Robinhood launched its UK offering. Well, Bloomberg Intelligence says consensus sees the retail trading platform's revenue jumping by 40% this year, even as net interest income tailwinds fade with U.S. rate cuts. Well, I'm very pleased to welcome Vlad Tenev, Robinhood Chief Executive Officer. Vlad, so good to see you in London and so good to see you in the studio. You've been here for a couple of weeks. So talk to me about what you're offering to the UK. You've rolled it out about 6 months ago. How's it going and what more do you have planned?
Yeah, thank you for having me. Always good to be here in London. I think for the UK, the value proposition is really Robinhood's the best way to invest in U.S. markets and U.S. dollars. So we're offering trading and investing in U.S. stocks. And we have a particularly innovative offering that we call 24-hour market, which allows over 1,000 symbols to be traded around the clock. Particularly useful here where there's less overlap with U.S. East Coast market hours.
But so, Vlad, when you look at, at the moment you allow consumers to invest in U.S. stocks, are you going to open that up to other asset classes?
Yeah, absolutely. So the first priority is making all of the great functionality that we became known for in the U.S. available to U.K. customers. So margin investing in particular is coming in the coming weeks. There's been a huge demand for options as well, options on U.S. equities, because that's just hard to come by here in the UK market. So we really feel like we can differentiate with U.S. offerings. But of course, we're looking ahead to multi-currency wallet support and local execution, including the London Stock Exchange.
I mean, it's exciting. So in what kind of time frame? I mean, so margin in a couple of weeks.
Yeah.
And then every couple of months, something more?
That's the idea, yeah. Every couple of months. I mean, we have a long backlog of things, and we're continuing to build new things. So we've talked a little bit about new asset classes that are likely going to come to the U.S. first, like futures trading. But really, we think Robinhood can offer a differentiated service for UK investors who want exposure to broader global markets.
Vlad, we've been talking a lot about IPOs and the fact that the IPO market in the UK and London is a bit meh. It's like it's okay, but actually doesn't really get people invested or excited about. Do you see that translating into your platform, that the lens through which people invest just needs a bit of a boost?
Well, I think that one of the things that we offer by being a U.S. platform and giving access to U.S. stocks is that diversification. So even if the UK IPO market or the UK markets have ups and downs, the US markets are available for customers. So having more options and lower cost options that are easy to use, I think is needed here and really is good for the consumer.
But is there more of an appetite towards fixed income products because of an appetite for risk? And do you see that changing?
Fixed income products are interesting. So with the retail audience, we found that keeping it as simple as possible and really meeting the customer's core need, which is, in the case of fixed income, lower risk yield. And so we have a great product called Cash Sweep, where we can allow our customers, even when they're not investing in equities, to earn a yield on dollars on the platform. Right now it's 4.5% with up to $2.5 million of FDIC protection. So it's been a very popular product. And if you want to diversify into holding US dollars as a UK customer, I think it's the best value proposition on the market and very easy to use through Robinhood.
Yeah, of course, we don't give investment advice, but it's a good pitch. Vlad, when you look at some of the interest rates, I mean, you've been able to hold on to a lot of deposits because you offer higher returns than some of your competitors. As the interest rates go down, what does that proposition look like?
Yeah, it's interesting. When, no pun intended, when Robinhood first went public in 2021, there was talk of Robinhood being sort of like a zero interest rate business. We'd done so well when rates were low because we had brought so many people into the markets to start investing in trading. The question was, how would we do if interest rates went up and kind of the tailwinds for the markets decreased? Because as you know, interest rates going up is kind of inversely correlated with stock market activity. But it took a lot of hard work. We had to essentially refound the business, mobilize towards retirement products, toward high yield. We launched a credit card in the US, and we built the business up to a point where net interest income actually surpassed transaction volume as our leading source of revenue. So our approach is we're going to continue to roll out new products. Many of our products actually will do better in a lower interest rate environment. For example, margin, which is coming in the UK, as well as options trading, more of our active trading products. Interest on cash becomes less attractive, but I think overall the business and the value proposition for customers should benefit even more from a lower interest rate environment.
Talk to me a little bit about, what happens after the UK. Are there any more international frays that you want to get into?
Yeah, so we're live in the European Union as well with our crypto offering, and we have a large crypto business as well. And really the focus in these two markets, UK and EU, is rounding out the product suite. So in the UK, people want more active trading products. There's some demand for crypto as well. And in the EU, customers want to invest in stocks. So we're going to round those out. And of course, in parallel, we're looking to expand to other markets. The long-term vision is every retail customer worldwide should have access to Robinhood and should get the lowest cost and easiest to use access to financial services possible through our platform.
But Vlad, I mean, Europe's crypto regulation, is kicking in at the end of the year. So how does that change some of your offerings or some of the products?
That's one of the reasons we wanted to enter the market, because Europe does provide clear rules of the road. They regulate things like initial coin offerings, staking. There's sort of like clear paths to offering some of these crypto services. And this is one area where Europe's actually, in some ways, ahead of the U.S. in regulation. And, as an American and a European, I have mixed feelings about this. They're sort of behind in AI, somewhat ahead in financial services. But that's one of the reasons why we're excited about entering that market.
Are there any countries in Europe where you're looking for a full MiCA license?
We are looking to get that when it goes into effect. Yeah, certainly.
Where in all the countries where you're in at the moment, or are there specific countries that you want to target?
We're licensed in Lithuania currently, but we might also get specific licensure in different markets depending on the particular local laws and regulations.
I have 1,000,001 questions, but let's talk a little bit about the U.S. You face competition from Schwab, Interactive Brokers on the retail brokerage space. How do you see that evolving in the next 12 to 18 months?
Yeah, I think that if you look back at the last 3 quarters we've reported, we've seen net inflows from all of our major competitors. So customers have been bringing assets to Robinhood from Schwab and from the others because there's been consolidation. As you probably know, Schwab acquired TD Ameritrade, which was a large active trader platform. Morgan Stanley acquired E-Trade. And so a lot of these customers are being force migrated to unknown platforms. And that forces them to kind of take a look at what else is out there. And a lot of them see Robinhood, they see the compelling pricing, the user experience, and this has been sort of like a extra nudge for them to move their assets over. And we've been doubling down on that, adding more products, more account types in the U.S. We have our first active trader event where I'm going to announce some new exciting products. That's in a couple of weeks in Miami. And so we've really been accelerating and trying to make it even easier and more compelling for customers to move all of their investment activities to us.
I mean, is there a danger? Can you give us a little bit of an idea of what the announcement will be? And is there a danger that you're going broad maybe too quickly, or is that really the aim because you want to get a little bit of market share? Like, do you have an ideal customer in mind?
Well, we have several types of customers, but the kind of core of our business is the active trader. Right. And the number one priority that we have as a business is to actually be the leader in the active trader market. If you look through 2023, we grew our market share in options by just under 20%. Equities grew by 14%. So we're on a path to that. And certainly there's ways to accelerate. Like, we're great on mobile, but our web product has some room for improvement. Up until recently, we weren't that competitive on margin, but now we have the leading rates in the industry. So there is a focus on active traders, but we don't want to just be an active trader business. We see much more potential for serving the mass market for that. And so we built compelling retirement products, which we hope to bring to the UK soon as well. The cash yield product, the credit card. I think that the more breadth of products we offer, the more compelling it is for a customer to bring their entire financial life into Robinhood.
So in the UK, is Revolut your biggest competitor?
I think there's a number of small startups. But I think the interesting thing about the UK is, unlike the US, there hasn't really been a zero commission revolution. You know, if you're a customer of one of the big brokers like Hargreaves, you're still paying, £10 a trade. And I think the incumbents here still have the majority of the market share. And so, there are some fintechs that have launched compelling products, but the market itself hasn't transformed in the way that Robinhood has transformed the market in the U.S. And since we launched in the U.S., individual household investment in equities has gone up something like 27%. In that time period in the UK, it's been basically flat. So we're hoping to change that here.
Talk to me a little bit about your other venture, Harmonic. How does that fit in? I mean, you raise money with it. How does that fit into the Robinhood ecosystem?
Completely separate company.
So it doesn't feed in at all?
No, Harmonic is an AI business. We're building what we call mathematical superintelligence. And the idea is that, the current large language models that are out there are particularly good at, writing history essays, but we see gaps in their ability to produce verified output that is trusted. They hallucinate, they confidently state wrong things. And we want to solve this with mathematics by kind of imbuing mathematics as a primitive. And the side effect is the models that we build could then be used to solve really high stakes quantitative problems where accuracy is actually very critical. I mean, and that could be applied to financial services.
I was going to ask, the application could actually be in super algorithms.
Yeah,
right?
Financial services is obviously a a big application of that, but so is aerospace, automotive, anything where the consequences of writing software with bugs and fundamental errors can be grave. So, I think the current models in AI don't adequately solve this problem, and there's like a convergence of forces that make now the right time to kind of build this technology.
Vlad, thank you so much for joining us today. We went around the world looking at all of the things that you're trying to solve. Vlad Tenev, the chief executive of Robinhood. Now, coming up, EU member states vote on whether to impose tariffs on Chinese electric vehicles. So which way will the vote go? We'll be discussing that next, and this is Bloomberg. Well, the EU is voting on tougher tariffs on Chinese EV imports, with Germany reportedly indicating that it will vote against them. Now, with us now is Bloomberg's global automotive editor, Craig Trudell. I'm much preferring you a card czar, but we're also joined from Hong Kong by our Asia transport reporter, Linda Liu. So thank you both for joining us. Craig, I mean, which way will it go? As always, member states of the EU don't always vote in the same way.
Yeah, that's right. And I think it would be surprising if we do see these tariffs go ahead and Germany be on the sort of losing side of this. We wouldn't necessarily expect that. I think it would be somewhat of a rarity and kind of remarkable, right, in the sense that Germany's automakers are really unified in opposing these tariffs and have come out very loudly saying so.
When you look, Linda, at some of, if these are passed, what are some of the measures that could, I guess, trigger retaliatory duties from China?
So Beijing has hinted that it's not beyond taking retaliatory measures. It's already launched anti-dumping investigations into pork, which could affect Spain, as well as brandy, which can affect France. It's also hinted that it could take action against large engine cars imported into China, as well as dairy. So how Beijing responds is very much dependent on how this EU EV tariffs votes will go. So I think some of these companies in the EU would be maybe lobbying their governments to vote in a way that can protect their interests as well.
Yeah, and Craig, Germany was really quite careful. We also spoke to one of the chief economic advisors, and then we heard from Robert Habeck, the economy minister. I mean, they were floating the idea that actually China could self-regulate, or at least say, like, look, we're going to export, but we'll cut down on the subsidies. Is this something that's being talked about?
Yeah, I think it is being talked about, and I've found it very interesting that, just in the lead up to this, we've seen the Chinese companies not necessarily price so aggressively in Europe. It was almost as though they were trying to avoid this by not undercutting, pricing. They weren't necessarily coming in with, 5,000 or 10,000 euro difference in segment. It was as though they were trying to, take pricing here that they can't pull off in China because of just how competitive the market is there. And even despite that restraint that they showed, they were able to gain some traction, and it did set off alarm bells in Brussels.
So, Linda, again, I guess the two sides are still exploring these ideas, which I have to say are pretty complex, or mechanisms to kind of control prices and volume of exports. Is that something that China, on the Chinese side, they're taking very seriously, Linda?
Yes, so Chinese trade bodies, as well as the Chinese Minister of Commerce, have visited Europe, as well as sending proposals by making price guarantees, selling no below a price threshold, as well as controlling export volumes. So we heard that some of these proposals have been put forward to the EU. It's not unclear how much the EU will accept this, given the entire auto industry, as well as the thousands of jobs that are on the line domestically. You've also got talks of Chinese companies looking to localize production in Europe to get around the tariffs. Now, I think that would be a welcome move for the region. But again, I think China is delaying making big decisions pending on how this vote will turn out.
Yeah, and Craig, again, if there's an escalation, is it again the German car makers that get slammed, like Volkswagen and BMW?
Yeah, I think Linda mentioned earlier the retaliatory threat of cars with large engines that would hit the German car makers hard, but it would also hit some companies that don't necessarily sell in big volumes, but China would makes for a significant share of their volumes. Think companies like Ferrari or brands like Porsche. These are manufacturers that don't necessarily sell in huge volumes, but it's a significant share of their business. They too are concerned about this as well.
Thank you both for joining us. Bloomberg's Craig Trudell there and Linda Liu. Now, coming up, we take a look at FX as bets shift on BOE and BOJ rate paths. That's next, and this is Bloomberg. Welcome back, everyone. Pound gaining slightly this morning as BOE chief economist Hugh Pill called for gradual cuts in a speech. Now, sterling saw its worst day against the euro in almost 2 years this week as Governor Andrew Bailey suggested the BOE could take a more aggressive approach to lowering rates. Well, joining us now for more is Rachel Evans, Bloomberg's managing editor for FX and rates for EMEA and the U.S. Rachel, always great speeches, especially on these big market moves. Andrew Bailey yesterday kind of really moved the markets. And so I don't know whether the message from Hugh Pill today is like, wait, hold on, or whether he's just always more on the hawkish side.
Yeah, so, I mean, there probably is an aspect of the BOE trying to balance things. I think yesterday's moves did seem to extend maybe a little bit further than maybe Bailey had anticipated in those comments, which were relatively anodyne. We're talking about more aggressive cuts possibly being necessary. But the market is so sensitive to any sign that the BOE is going to have to cut faster. We have an awful lot of people betting on more pound strength at the moment. So there really is that kind of propensity to, if you see something that undermines that position, to get out and then ask questions later. So there may have been a sense to which Pill was kind of trying to moderate those comments a little, put a little bit of a kind of ballast under the pound. But he has been more hawkish of late. So we did see, for example, in August, when the Bank of England did cut interest rates, that Pill was one of those actually voting to hold interest rates at that point. So I think there is also a little bit of this is kind of Hugh Pill expressing his stance, his position within the Bank of England Monetary Policy Committee.
What's your take on yen? I mean, again, a lot going on. We have an election October 27th. We're just getting to know this possible new prime minister as well.
Yeah, and I think the market is as well. It felt like, earlier this week, maybe he'd kind of gone a little bit further than perhaps he thought he'd gone in sort of talking about the Bank of Japan being in no rush to kind of hike rates. He came out today and there was a bit more kind of colour around that, saying that, he and Ueda, the Bank of Japan governor, are very aligned in terms of policy. So trying to put a little bit more clarity around those remarks. But certainly, I mean, this was something that really did move the yen. We saw more than kind of a 2% sort of weakening in the currency on, I think it was Wednesday this week. So, I mean, I think it shows you just how sensitive the market really is to just the political and the monetary policy decisions within Japan, given that we have had so much scrutiny of that dollar-yen exchange rate. Obviously, the authorities there really want to see a stronger yen, and anything that kind of like puts that case back and weakens the yen is not going to be something that does them any favours. It actually makes the possibility of a bigger hike more likely.
Rachel, thank you so much for the terrific briefing. Rachel Evans there with the very latest on some of the big FX moves. Up next, Bloomberg Brief, Manus Cranney in New York, and this is Bloomberg.